Welcome to the debate. So last year, a global logistics giant watched $5.5 billion of its market value just evaporate.
Which is a staggering number to even think about.
Right? And the crazy part is it wasn't because of a sophisticated cyber attack. It wasn't, a sudden global recession.
Right.
It happened because they simply lacked the manual labor required to repair basic wooden pallets.
Wooden pallets.
Literally just wooden pallets. Without them, you can't move goods. And when you can't move goods, inventory gets trapped, cash flow freezes, and, well, billions in values simply vanish. But at the exact same time, the world's largest industrial companies are spending billions to build artificial intelligence digital twins of their factories.
It really is a fascinating contradiction, isn't it? I mean, you have these legacy-heavy industries, steel, automotive, manufacturing, trying to simultaneously operate in the mud and in the cloud.
Exactly. We are watching legacy industrial sectors navigate this unprecedented capital supercycle. So today, we're providing a strategic industry briefing on what we're calling the Great Industrial Pivot. And the core question we are debating is this: is the aggressive reallocation of capital towards software-defined business models, AI infrastructure, and decarbonization a necessary evolution to secure market leadership?
Or is it a premature, capital-destroying distraction, right? Because that's really the other side of the coin. Does it ignore the incredibly acute, very real vulnerabilities in physical supply chains and, legacy cash generation engines?
Exactly the tension we're looking at. Now, I represent the perspective that this pivot is frankly an absolute existential imperative. Industrials must transition to software-enabled, decarbonized models if they want to achieve secular growth and, more importantly, if they want Wall Street to re-rate their valuation so they are priced more like tech companies and less like metal benders. They have to make this leap. The legacy hardware of the past century, well, it now serves primarily as a funding mechanism for this intellectual property-heavy future.
And, I come at it from a very different perspective. I view this transition, at least in the way it's currently being executed, as dangerously capital destructive in the near term. There is this boardroom obsession with capturing tech multiples, the idea that if you say AI enough times, investors will value you like a Silicon Valley startup.
Which they desperately want.
Of course they do. But that obsession is blinding management teams to the unforgiving realities of heavy industry. I mean, the massive capital expenditures required to fund this future are absorbing working capital at alarming rates. While executives dream of, software like 80% profit margins, basic physical supply chain failures and geopolitical realities are currently destroying real value. We are severely underpricing execution risk.
I see why you think the risk is being underpriced, but let me give you a different perspective on why companies are chasing that multiple. It isn't just vanity, it's survival.
Survival?
Yeah, survival. The shift toward asset-light, software-defined revenue is arguably the only credible strategy to escape traditional industrial cyclicality. Historically, when the economy dips, industrial valuations just get hammered, right? Because their earnings are tied to heavy, inflexible physical sales.
Sure, cyclicality is a real pain point.
But consider what happens when a company like Aptiv expands its partnership with NVIDIA to deploy edge AI across automotive platforms. Or when Hitachi starts embedding Intel's AI across its entire industrial portfolio.
Right.
They are establishing high-margin recurring software revenue. Hardware is rapidly becoming the Trojan horse for software subscriptions. If you only sell the physical box, you surrender the margin entirely. I mean, isn't resisting this software pivot the equivalent of a mobile phone manufacturer back in 2010 stubbornly refusing to build an app store?
Okay, that is a clever analogy, but I'm sorry, I just don't buy that industrials can magically transform into app stores.
Why not?
Because industrials are fundamentally not software companies. You use the term asset-light. The core infrastructure required to power this supposedly asset-light AI future is decidedly physical, and it is unbelievably capital intensive.
Well, obviously, you have to build data centers.
Exactly. Think about the structural increase in power consumption required for artificial intelligence data centers alone. It's triggering a multi-year capital expenditures supercycle. You see companies like First Solar or LS getting massive valuation bumps because they supply the power infrastructure. But to actually deliver on that demand, they have to pour concrete.
Right.
They have to build vast new manufacturing capacity, secure copper wire, and hire specialized labor. It's not asset light at all.
Okay, wait, let me pause you right there because I want to make sure I am following your logic. My premise, and arguably Wall Street's premise, is that leaning into software makes these companies leaner. You are suggesting that this tech pivot is actually making heavy industrial firms more capital intensive in the short term? That feels entirely counterintuitive. Walk me through the mechanism there.
It is counterintuitive, which is exactly why the market is mispricing it right now. You cannot software update your way out of a factory capacity bottleneck. When a company commits to supplying the AI revolution, they drain their free cash flow to build the physical facilities required. They are having to pursue complex, long-duration financing just to fund the steel required to build the factories. The multiple they get rewarded with is speculative, but the billions they are spending on raw materials right now are very, very real.
You're sacrificing your near-term return on invested capital, the actual cash your existing assets generate, in exchange for a tech valuation that might just evaporate the moment the AI hype cycle cools down. Okay, I hear the friction you're pointing out. There is undoubtedly a massive capacity build-out happening, but I would argue it is precisely the promise of that software and AI multiple that enables these companies to secure the financing they need on favorable terms.
You mean cheap debt?
Equity currency, actually. When a company's valuation expands because the market believes in their AI or green infrastructure strategy, it gives them incredibly valuable equity currency. It bolsters their credit profile. They can raise capital much more efficiently than a legacy company that is perceived as a dying dinosaur. But your point about draining cash flow brings up a crucial piece of this puzzle, which is the dual-track capital allocation dilemma.
Right. The question of how you actually pay for all of this without bankrupting the company.
Exactly. And the reality is, the most sophisticated companies are executing highly disciplined capital recycling. They are actively harvesting their legacy, carbon-heavy businesses to pay for the green and digital transition.
Harvesting.
Yeah, think about General Motors. Recently, they committed over $800 million to upgrade legacy internal combustion engine plants in places like Romulus and Saginaw. At first glance, investing in gas engines seems entirely backwards for a company pitching an electric future.
It certainly looks that way to a lot of ESG investors.
But it's a deliberate, highly sophisticated strategy. They are maximizing the near-term cash generated by their highly profitable legacy gas-powered trucks, and they're using that precise cash flow to fund the capital burn of their EV platform. Or take Renault. They took their internal combustion engine assets and put them into a separate joint venture called the Horsepower Train.
Which is essentially an accounting maneuver to clean up the main brand.
I disagree. It is much more than an accounting maneuver. It's a structural masterclass. By moving the legacy gas engines into a joint venture, Renault can still extract the cash dividends to fund their transition, right?
Right. The cash still flows.
But those dirty assets no longer drag down the core brand's future EV multiple on the stock market. Investors can clearly value the clean, future-facing growth engine without it being muddled by the declining legacy business.
That all sounds brilliant in a PowerPoint presentation, but have you considered the sheer fragility of that straddle strategy in the real world? It is bleeding balance sheets dry. You hold up GM and Renault as the gold standard, but let's look at the broader reality. Take Ford.
Okay, Ford.
Their electric vehicle division, Model E, lost hundreds of millions of dollars in a single quarter recently. It is a massive capital incinerator. And what happens when the future tech division loses that much money? The legacy business has to constantly bail it out. You're creating a structural dependency where the old business has to run flawlessly at peak profitability just to fund the losses of the new business.
But that is exactly the point of the transition phase. The legacy business is the engine.
But what happens when that engine misfires? You cannot safely harvest a legacy business when the broader macroeconomic and geopolitical environment is actively attacking it. We saw Toyota take a massive hit to its operating income
directly tied to U.S. tariffs and heightened supply chain costs.
Well, tariffs are a headwind for everyone.
But it destroys the funding mechanism. Volkswagen saw its operating profit drop significantly because of those same tariffs, plus, hyper competition from localized brands in China. The masterclass strategy you are describing requires a perfectly stable geopolitical environment to generate that cash. Funding a multi-billion-dollar green transition is incredibly fragile when your core cash cow is fully exposed to unpredictable tariff volatility and trade wars.
Look, the geopolitical landscape is undeniably complex right now. I'll give you that. But the executive teams aren't just sitting there letting tariffs wash over them. That is exactly why you see these companies aggressively accelerating their footprint rationalization.
Meaning moving factories.
Right, physically moving their supply chains. Automakers are pushing for localized, regional supply chains to insulate their margins from cross-border tariffs. And frankly, the cash generation of these legacy assets, even with the immense tariff pressure, remains incredibly robust. I mean, we saw Stellantis demonstrate serious balance sheet strength in their recent operating income,
Yeah, they had a strong quarter.
which gave them the flexibility to execute accelerated share repurchases while still funding new platforms. The dual-track strategy works, provided the corporate treasury function manages the cash conversion cycle tightly.
Okay, I have a lot of respect for corporate treasurers, but a treasury function cannot magically print flawless physical execution. And that exposes the deepest flaw in this whole narrative. The grand, ambitious boardroom greenfield projects are completely disconnected from the granular operational fragility of the real world. We just talked about the macro environment being hostile, but the micro environment is actively breaking down.
Give me an example of the micro breaking down.
Let's trace the green steel transition. SSAB is trying to build a multi-billion-dollar fossil-free steel project in Sweden. They are facing completely unpredictable permitting delays.
Permitting is always slow.
But it freezes capital. You can have the best financing in the world, but if the local government won't give you a permit, your project sits idle. Or take Tata Steel. They suffered an 8-month delay on an electric arc furnace in the UK. Why? Because of grid connection issues, which was then compounded by a major facility fire.
Industrial accidents and grid delays happen. That doesn't invalidate the broader strategy, though.
It doesn't invalidate the end goal, but it absolutely destroys the financial modeling that justifies the strategy. Do you know what an 8-month delay means mechanically?
Trapped capital.
Exactly. It means you have billions of dollars trapped in non-productive, work-in-progress inventory. It destroys your return on invested capital. You're paying interest on the debt used to build the furnace, but the furnace isn't generating a single dollar of revenue. And it gets even more basic than massive furnaces. We were talking about General Motors funding its future with its highly profitable trucks. Recently, that entire high-margin truck production line was threatened by a single labor dispute at a critical axle supplier because GM only had a 2-week inventory buffer. Which brings us right back to your opening story about the wooden pallets.
I knew you were going to bring up the pallets.
I have to. A logistics giant lost $5.5 billion in value because they lacked the labor to nail pieces of wood together. How can you confidently prioritize a software-defined multiple or an AI digital twin when the physical foundation of the business is so fragile that a wooden pallet shortage can erase billions in equity?
Okay, I think using a broken wooden pallet to argue against modernizing the global industrial base is missing the forest for the trees. Yes, there is friction when you are fundamentally re-architecting the physical world for decarbonization and digitalization. There will be grid connection delays. There will be localized labor disputes.
Major ones.
Sure, major ones. But isn't that exactly why the financial and operational tools we are using have evolved so dramatically? We use structured treasury solutions to solve the pallet delay so that we can use our strategic capital to ensure the company matters in the next decade.
What does that actually mean in practice, though? How does a treasury tool fix a broken axle supply chain?
It's a great question. Let's take the GM axle supplier example. If a critical Tier 2 supplier is choking on cash flow and facing a labor strike because they can't make payroll, the parent company doesn't just sit there and watch their assembly line stop. They deploy deep-tier supply chain finance.
Okay, Right.
For anyone outside of corporate finance, this basically means the parent company arranges for a global bank to step in and pay that struggling supplier's invoices immediately, usually at a slight discount. The supplier gets instant cash to end the labor dispute and keep producing axles, and the parent company pays the bank back later on their normal 90-day terms.
Essentially acting as a buffer.
Exactly. It injects liquidity exactly where the supply chain is breaking down, without the parent company having to drain its own corporate reserves. The operational challenges you highlight are very real, but they are manageable technical problems. They are not existential strategic flaws.
I strongly disagree with dismissing them as merely manageable technical problems. When Tata Steel faces an 8-month delay to connect a furnace to the power grid, no amount of supply chain finance is going to solve that. You cannot discount a grid connection.
Oh, obviously.
That is a hard, physical infrastructure constraint. It delays the realization of all the environmental and financial efficiencies the board promised investors. It forces management to scramble for expensive bridge financing just to cover the business interruption. And the volatility isn't isolated. Look at the logistics sector. We saw Kuehne plus Nagel experience a massive collapse in sea freight profitability recently, which forced them to pivot sharply to air freight just to protect their margins.
Yeah, they had to move fast.
Right, because the physical movement of goods is subject to extreme cyclicality. My fundamental concern is that by hyper-focusing on the shiny software and AI story, executive teams are under-resourcing the boring, unsexy operational resilience required to actually survive the economic cycle. You cannot build a digital twin of a factory if the physical factory burns down or can't secure a local building permit.
I concede that physical bottlenecks are the ultimate constraint. I do. But that is exactly why the role of advanced financing has become the most critical component of this entire pivot. To build the physical factory, you need the public markets to believe in the digital twin. The strategic narrative we are unpacking today really hinges on the fact that companies must navigate this supercycle utilizing financial tools they barely touched a decade ago.
Give me an example of the tools you think are bridging that gap.
Look at how companies are protecting their credit ratings while spending billions. We are seeing massive deployment of corporate hybrid capital. Mechanically, this is debt that rating agencies treat partially like equity.
Ah, yes.
It allows a company to borrow heavily to build out these AI data center cooling systems or green steel plants without tanking their senior debt rating. We are also seeing companies issue benchmark green bonds by explicitly tying their debt to sustainability targets, like funding electric bus platforms. They can tap into dedicated ESG capital pools that offer highly favorable long-term interest rates. The market rewards the strategic vision with the cheap capital required to fix the physical friction you're so worried about.
And honestly, that is exactly where we find a deep point of convergence in this debate. Regardless of whether you believe the tech multiple chase is a visionary necessity or a dangerous distraction, we both have to agree that navigating this supercycle requires unprecedented financial sophistication.
Unprecedented.
The sheer volume of cash being absorbed by these transitions right now is staggering. Think about MSC, the marine transport giant. They are committing to massive greenfield terminal projects on the U.S. East Coast. To do that safely, they have to use non-recourse project finance facilities.
Which essentially ring-fences the risk of the new project away from the parent company. Exactly. It isolates the construction risk so that if the terminal faces massive delays, it doesn't destroy the corporate debt capacity of the entire shipping line. Or consider Acre Solutions securing an 80 billion krone backlog. Just to bid on international pipelines of that size, they have to deploy scalable multi-currency guarantee facilities. The demands on corporate treasurers to manage cross-border currency exposure, to optimize cash pooling across dozens of countries, and to execute sale and leasebacks to unlock capital trapped in physical real estate, the pressure has never been higher.
I couldn't agree more. The financial architecture has to be every bit as innovative as the product engineering. When a legacy hardware giant partners with a semiconductor manufacturer to embed software into their platforms, the intellectual property structures, the revenue sharing agreements, and the cash flow visibility require entirely new operating models. The legacy industrial era was largely about managing the physical depreciation of heavy equipment over 30 years.
Yep.
The new era is about managing rapid innovation cycles and software monetization,
while the factory is still running.
But with the distinct and immovable caveat that if you neglect the physical supply chain, if you ignore the localized labor negotiations for truck plants in Spain or the raw material bottlenecks for EV batteries in South America, that rapid innovation cycle will grind to an incredibly expensive, highly embarrassing halt.
Which provides the perfect transition to the strategic takeaways of this briefing. We've covered a lot of ground today, from AI multiples to wooden pallets. If you were sitting in the C-suite or the boardroom right now, charting the course for the next decade, there are really 4 critical uncertainties you have to resolve. The most glaring one, given our entire conversation, is whether the aggressive pursuit of a software or tech valuation multiple is actively blinding your organization to the gritty, physical supply chain resilience required to actually deliver your core products.
That is absolutely question number 1. And if you recognize that risk, the immediate follow-up is structural. How are you ring-fencing and insulating your legacy cash cow businesses from the severe capital drain of your future tech and EV investments? You have to ask if those new entities are structured to survive independently if the transition timeline extends longer than the market anticipates.
Which naturally leads to the financing piece. The third question executives must ask is whether they have the structured financing architecture in place today. Do you have the sustainability-linked bonds, the deep-tier supplier finance programs, and the hybrid capital facilities ready to survive a multi-year capex cycle without destroying your near-term liquidity? Because the cash will run out faster than you think.
It always does. And finally, the macro question. Are you actively hedging against the geopolitical tariffs and localized regulatory delays that threaten your transition timeline? Because making an unhedged bet on frictionless globalized trade right now is an exceptionally dangerous position for any industrial firm.
The strategic realities of the great industrial pivot are incredibly complex. There are layers of capital allocation, operational friction, and technological promise that we are only just beginning to see play out. There is so much more to explore in the underlying material regarding these industry inflection points, and we leave it to you, the listener, to weigh the evidence for your own strategic planning. But remember the disconnect we started with. We are trying to build artificial intelligence digital twins while the basic wooden pallets beneath our feet are splintering. The technological vision must be brilliant, the financial engineering must be flawless, and the physical execution must be grounded in reality. If any one of those 3 fails, the entire transition stalls. Thank you for joining us on The Debate.